I think we should bring in our guest, Tom McClellan. How are you doing today, Tom?
I'm glad to be with you.
Hey, welcome, Tom. It's I know the last time you were on here, actually, I think last couple of times you were on here, you've talked about some key metrics that you use. I think the euro dollar futures and advanced decline line on corporate high yield bonds, and how you've been able to plot some of that. Um, Looking back over history, you can kind of predict a little bit of what's going on. I mean, how's that faring? Or maybe I don't want to steal your thunder, but if that's what you're going to talk about, but I'm just wondering how that's been faring relative to what we've been seeing in the market.
I am going to go through that. And the interesting thing is that even though the U.S. stock market has been following the script generally, it's been doing it in a much stronger way than what I had expected. The U.S. market has been stronger. The rest of the world is suffering the illiquidity problems that are appearing on schedule right now, but the U.S. is somehow remaining more immune to it and not as subject to the problems. Maybe that's because of the tax cuts for corporations. Maybe it's because of the repatriation. It's hard to know exactly where the money's coming from to keep the market higher than I thought it was going to be. But that's what's going on. But we still have some corrective work to do. So if you don't mind, I'll plow right into some charts.
No, go right ahead. Jump in.
Okay. I'm going to make sure I can do things right. This is my my long-term leading indication for what the stock market should do. It's based on looking at the message from crude oil. Years ago, I put together a long-term picture of what prices of crude oil had been doing since as far back as I could get it, which was 1890. And I looked at that pattern. And I thought, I recognize this. And it looks just like the stock market, except that there's a key difference, a key distinction. You have to slide forward the plot of crude oil on the chart 10 years to get the two patterns to line up. So in other words, what it's saying is that crude oil gives us a 10-year leading indication for what the stock market's going to do. And if you remember 10 years ago, we were having the collapse of the commodity bubble, and crude oil went from 145 down to 37 in about 6 months. And so we're now at the 10-year anniversary of that point, trying to see what sort of echo of that we're going to get. This is zoomed in on the same relationship. And it's not exactly 10 years that you get these lags. You might notice that crude oil had a bottom in November of 1998. So if you add 10 years to that, it should have been November of 2008, but the real bottom was in March of 2009. So it's not perfectly 10 years, but it's about 10 years, and that's what gives you the best correlation overall. You also should notice that when you have a big exogenous event like the first Persian Gulf War in 1990, when crude oil doubled from 20 to 40 and then back down again, we didn't see an exact echo of that feature in the chart of the Dow, although it did top right on schedule. So the question has been for about the last 9 years whether we had to translate this action in crude oil prices exactly, or whether we're going to see some more muted version of that, and we'll have the full answer by the end of this year. But right now we're still in the throes of this moment of correction. The good news for the bulls is that after we get out of the echo of this, the crude oil's message says that the stock prices should get back to trending upward into the mid 2020s. We'll have some worry about it in around 2024, 2025, but we don't have to worry about trading that just yet.
Hey, Tom.
Yes, sir.
I know last time when you were on here and you showed that, I mean, I was fascinated. I still am, but I can't come up with the reason why there's that 10-year lag. I mean, have you been able to theorize as to what might be going on there?
Well, I studied engineering, so I always want to know how everything works and why it does what it does. As I've become a market analyst for a living, I've had to let go of my quest for the why, because if you looking back at this original chart, going back to all the history of the Dow, you don't have to understand why it works to take advantage of it. And at some point, when you have 118 years worth of something working, at some point you say, okay, I can stop asking why now, even if I don't understand the why. I'd like to know the why, but I don't need to in order to realize, boy, crude oil somehow knows the answer 10 years ahead of time. It may not be a cause and effect thing. I like to say it's not about causation, it's about indication. So regardless of what makes it work, it's a pretty effective messenger about what lies ahead. And I also don't know the why of why this one works. This is my euro-dollar commitment of traders leading indication. This is data from the COT report, or the commitment of traders report, and it's shifted forward a year on the chart to reveal how the stock market tends to follow in the same footsteps. right now we're in the summer corrective mode of what it said is supposed to be happening, and we're not getting a big down move in the S&P anyway. We still have a little bit more time until the ideal due date for that bottom, which is the last week of August. Understand this is weekly data, so it's not going to tell you at 2 o'clock in the afternoon on Tuesday is when you want to buy. It's just not going to be that good. Zooming in a little closer, here's what it looks like. The S&P is doing a much more upward version of this, even though it's putting in the bottom and the top and the bottom. It's getting the dance steps right. It's just dancing upward, whereas this thing said we should be dancing lower. And there's that late August bottom. Once we get past that, I have no problem expecting that the market should go screaming upward. I realize this is kind of wild for people to have a crystal ball, a roadmap of exactly what the stock market's going to look like. And it doesn't always work exactly right. We had this big rogue wave in January to that February crash low. And then it got back on track and right on the pattern and doing what it was supposed to do. So every once in a while, the stock market gets a wild hair and does something wildly different. And that is a risk factor when you're using any forecasting tools. But I mentioned that the rest of the world is seeing those liquidity problems. Here, just for example, is Brazil's Bovespa index, and it has fallen just like this Eurodollar commitment of traders leading indication said should be happening. It's had a nice rebound, but it's probably not done till that late August due date. The rest of the world is suffering the illiquidity problems that this indicator told us about. And for some reason, the US is just not suffering those liquidity problems as much. Turning to a new one, this is the presidential cycle pattern. That's like an annual seasonal pattern, except that you're using a 4-year season and you're averaging the behavior of the stock market together to get an ideal pattern of what the stock market does. And it too says we're supposed to be in a stepping downward pattern, but the S&P 500 is doing the steps, but it's going upward. It says September 20th is our ideal bottom date, and then we can go up like a scalded dog in the fourth quarter, but we still have some more corrective work to do. Quite often when you see the S&P 500 go wildly off track like this, like it did in January, it works extra hard to get back on the pattern. So I'm expecting that we could see a rollover and a pretty hard down to late August to early September. I'm fishing around with my other tools to find out exactly when that bottom is going to come in, and I don't have it yet, but it's not here yet. We have some more of this choppiness to do, and so I will be much more excited come September about being wildly bullish than I am right now. Any questions about that, Tom or Aaron?
No, just fascinating. I'm just watching.
All right, moving on. Here's that same chart. I'm just zooming in real close, and you can see what I call the dance steps are there. It's not the same exact appearance. Just like if I were to dance the Charleston or if Fred Astaire dances the Charleston, it's still recognizable as the Charleston, although it looks a lot better when he does it. It's still the same dance steps. And so we're right here at the echo of what this pattern says should be a peak. We should have a down move, some more up and down, but September is more like when we should look for a real bottom that we get to go up out of in a nice big way. We are starting to finally see some weakness in the breadth statistics, the advanced decline numbers. Here's the Dow Jones Industrial Average on top as a price indicator, and the New York Stock Exchange advanced decline line, which stock charts users can pull up as a symbol on your own system. What you want to see out of this is that most of the time the two are going to move together. When they disagree, like we had a little bit of a disagreement in October to November 2017. That's a bearish divergence, but it only lasted a little while, and then the advanced decline line went back to showing nice strength. In fact, it's been acting stronger than prices have been up until just now. Now we're finally seeing another bearish divergence where the Dow and the S&P 500 have gone higher, but the advanced decline line is going lower. And so now it's finally giving its permission to let the corrective work that's supposed to be going on this summer start to take place. We've already had that message elsewhere, and I'm going to get to that. But there's an issue that I think that everyone needs to hear about. You guys have probably heard that if you really want to look at what the advanced decline line is saying, you should look at the common stocks or the operating companies only version of the advanced decline line. And I'm going to tell you that is slightly misguided guidance. Here is the common only advanced decline line. This is data that I keep. It's just about 60% of all the issues that are traded on the NYSC. And supposedly, it should give the better message because you're looking at what actual stocks are doing. And I'm comparing it to the New York Composite Index just for a price comparison. But what you find with the common only version is that when it says things are bullish and the prices say things are bearish, you'd want that to be a time when things are going really well and you should ignore the message of a lower high in prices. But the common only advanced decline line just doesn't do that reliable of a job of giving the message that you want the advanced decline line to give. Here you had the advanced decline line was acting stronger earlier this year and the prices were going lower and boom. And so now we've already had the common only advanced decline line saying, hey, everything's fine, everything's wonderful, but prices are making a lower high. And just like all these other divergences you get, it's time to listen to what prices are saying. I originally thought that common only numbers were better. They should be better. That makes the most sense. But after years of looking at them, I realized, gosh, they're just not as good of an indication as everybody thinks. So I tell people, look at the composite version of the advanced decline line. Don't focus on the common only version. I realize that's out of step with what a lot of people will tell you, but it's a conclusion based on what the data say. Here's how the breakdown happens in the NYSC. They have about 60% of the issues are what we would call common stocks. The rest are, there's a whole bunch of preferred stocks, which are more interest sensitive. There's different categories of closed-end funds. The bond closed-end funds are most often blamed for contaminating the data, but I actually like them. And this specialty category, that's everything else that doesn't fit into one of these other categories. So you got rights, warrants, when issued, structured products, a bunch of other odds and ends that don't fit into any good category. So it's really only 60% of the stocks on the NYSE are real stocks. And supposedly everybody thinks that's what's supposed to give you better indications, but we find out otherwise when we actually look at the data. Here is an advanced decline line on bond closed-end funds. So you're just counting how many of them go up versus how many go down every day. And it turns out to give a better indication than what the common only does. Notice back here in January, it gave us a nice bearish divergence right when you would want one. When the stock market was going up to that January 26 high, this was saying, oh, liquidity problems are here. We're having trouble. It continued saying that there was trouble all the way till about April, and it finally started to do better. And I expected that it's going to roll over and give us a confirmation of what the composite advanced decline line is saying. You could also notice that back here in 2016, remember when we had the flash crash? No, not the flash crash. That was the Brexit sell-off. This was saying, no, liquidity is not a problem. This is just an overreaction to news, so don't worry about it. It had a little bit of a problem right after the election. There's the election, pre-election bottom. But then it said, hey, everything's strong, everything's strong, everything's strong, only up until late 2017 when it started giving us that early warning. And that's what you want an advanced decline to do is give you that early warning that liquidity is starting to have a real problem. Now here's a really wild advanced decline line. This is on junk bonds. Or what they call high yield bonds over at FINRA. This is bonds that FINRA categorizes as either high yield or high quality, high grade corporate bonds. And it's the junk bonds that give you the real good message. When they are acting strong, it says liquidity is plentiful and everything's fine. When they are starting to have trouble, it says liquidity is drying up and the least deserving issues are starting to suffer. And you usually get that warning ahead of prices telling you that you have a problem. We're still having the message from them. They're still in a downtrend. They're back up to a 39-day EMA, or what we call a 5% trend, and failing right there. And I expect to turn down again. So the message from the extreme end of the liquidity spectrum is that liquidity is not really plentiful. The big cap U.S. stocks, the FANGs, they're all doing well, but the ones that are the most sensitive, the canaries in the coal mine, they're saying that there are liquidity problems, and they're not yet resolved. And I expect that to matter as we head into August for the overall stock market. Here's a long-term picture of that same advanced decline line for high yield bonds. And notice what it said back in 2007. It peaked all the way back in March of 2007 before the October high. And it said, big divergence, you got big problems. And at the bottom in 2009, it made a higher low. So it said, hey, liquidity is starting to come back even though before prices knew it. It gave us a big divergence in 2015. It gave us a big divergence at the top. So when you see a divergence in this indicator, you really want to pay attention to it. And it seems to do a better job, especially better than the common only version of the advanced decline line. Now, but I'm giving you all sorts of bearish highlights about how bearish I am between now and August. I want to come back to my Eurodollar commitment to traders model to focus everybody on this late August. Maybe it's going to be early September. I'm not exactly sure. You can see that when this low was due, the market was a little bit late. So the market doesn't have to bottom exactly on August 29th, just because that's when this equates to. There can be a little bit of lead and lag. So late August, early September is when I'm looking for a good low. And then we should get really, really excited about getting to ride a big up move into 2019. That is what it's showing. Much like the big up move that we had in 2017 that it foretold correctly. I'm really excited about buying this, but today's not the day. This is a little bit early, and late August to early September is a much better time to look for that. And if it's not improper, I'll close with a little plug. If people want to find out more about what we do, come to our website. You can subscribe to our newsletter, our daily edition. You can sign up for our free weekly chart and focus articles. You can also follow me on Twitter. Any questions, Tom and Aaron?
All right. Anything in the room, Aaron?
Yeah, actually, it was about your the two different AD lines. And could you explain again the difference between the common only versus the NYSC?
Well, in each case, you're looking at every day. You're looking at how many of something are going up versus how many of something are going down. That's the daily breadth. And when we're looking at the common only, you're focusing on just these 1,847 issues that are what we categorize as common stocks. There can be slight disagreement among some of them as to whether it's really an operating company or but we try to follow the methodology that the NYSC itself set down a few years ago. And you would think that the common stocks would give you the best answer about what these stock market averages are going to do when you look at their advanced decline statistics. And it's just not the case. It's not as reliable of an indication. Here's that advanced decline line for just the common stocks. And when it disagrees with prices, what you want an advanced decline line to do is tell you something different, and you want it to be better, a better piece of information. But when it's saying things are strong and prices are weak, that's not what you hire this indicator to do. You hire it to give you nice bearish divergences or bullish divergences that are going to be reliable ones, and it's just not reliable when you use it for the common only. The composite version of the advanced decline line is more reliable. The junk bond advanced decline line is more reliable. And it should be the case that the common only is more reliable, but it just is not. That's not a fact. It's a belief and a hypothesis, which doesn't happen to bear up with contact with the actual data.
All right, let's see. And then I do want to let everybody know, because they were asking if you can get both of those, if you can get the common only AD line on stock charts, and you know, the NYSE. We also have all of those are on stock charts. And if you want a quick and dirty way to do it, if you download that DP Market Indicators chart pack, just go to your account. And if you download that chart pack, we have a whole chart list on advanced clients. So you'll find them already made for you. So, and yes, we have the McClellan oscillator.
Doctors.com has probably the best collection of advanced decline and other breadth indicators that you can find anywhere. And I'm grateful that I can turn to that as a resource when I need to. I like to keep my own data just because I like it. But Chip has done a great job in amassing a wonderful collection of indicators.
Yep. So if people want to look at those, yeah, I'd recommend you look at the DP Market Indicators chart pack, and you just go to your account and you'll find out more information on that. And then the last one that I see here in the chat room is, you know, given your view of what's getting ready to happen, do you have any shorts you might recommend?
Well, this is what I'm still expecting to happen. The price S&P 500 is going up, and this indicator says it's supposed to be going down. That can happen for a while. The market can go off track, but usually it realizes it and then works extra hard to make up for lost time. It can also go off track, I should point out, when the Fed puts a big fat thumb on the scale during QE3, and this indicator was saying we were supposed to have a bunch of really bad liquidity problems in 2013. Well, the market went straight up in a nice big trend because the Fed was printing $85 billion worth of money and pumping into the banking system. So if the Fed is going to do that, it can overcome something like this. The Fed is not doing that right now. They're yanking money out at a rate of $40 billion a month. They're doing quantitative tightening, and it should matter. It hasn't mattered yet this summer. So I expect that the market's going to kind of wake up and realize it very late and try to get all the work done at the last minute to put in that bottom. And then it goes up in a really nice uptrend in Q4. So as to shorts, I'm short the S&P 500 for managed accounts, and it's not enjoying life for the last week as the market has kept going higher, but I still expect it to work out.
All right, so you're looking at more like ETFs for the short play.
Yeah, and it's more reliable that way because a single stock like the ones that you were talking about, you can have big news that can burn you, even though the market direction call is correct. One little bit of news on a single stock can really burn you. So I try to focus on what the overall market's going to do rather than individual stocks.
All right, that pretty much closes it out in the chat room for now.
All right, I got a couple questions for you, Tom.
Sure.
I follow history really closely. And one of the things that I've realized over the years, first of all, I ignore the whole go away in May and come back at the end of October, because I think that really is, there's no doubt that the performance during those 6 months from May through October is not as strong as November to April. But just to give you an example, May is a very strong month for small caps historically. So even though the overall market may struggle a little bit starting in May, there are definitely pockets of strength in the market. But one thing I've realized going through all my history is that from July 18th through September 26th, and I mention this because it lines up with a lot of what you're talking about. July 18th through September 26th is truly the time historically when you want to be out of the market. I've got a couple of numbers here, but as of last year, so since 1950 through 2017, so that's 68 years worth of data, the July 18th to September 26th period has produced annualized returns on the S&P 500 of a minus 2.45%. And while that may not seem like a lot, when you think about the average annual return over the last 7 decades has been close to 9%, it shows that this more than 2-month period has underperformed by about 11.5% on an annualized basis. And I think that's pretty statistically relevant. And it lines up with some of this weakness that you're talking about into August and September as we look forward. I'm very bullish going forward down the road. And I think from most of the charts I see here, I think once we get through this summertime period, it looks like you're fairly bullish as well based on a lot of the different signals that you use. I just wanted to point out that it does line up historically with what you're calling for, which is some weakness throughout August, maybe from now through August into September. And I know some of your lows, like the one you're showing right there on that chart, the presidential cycle pattern, your low is September 20th, which is within 1 week of that historical low that the market tends to feel around September 26th. Do you follow historical patterns?
I'm sorry to cut you off, but we always hear about sell in May and go away, and about the May to October period being weak. When in reality, the annual seasonal pattern statements that rhyme more than statements that don't. And you can't really make a great rhyming phrase that involves June. You can't say sell in June and who knows what. But as Johnny Cochran told us, if the glove don't fit, you must acquit. People learn that rhyming phrases tend to work better and tend to catch more. So that's why we're still stuck with the belief that you should sell in May. But it's also really different depending on which year you're in of the presidential cycle. In the second year, which is where we're at now the market peaks in April. In the first year, here's where May would be, and it keeps on going all the way up into July, and then before it starts going down. In the third year, it's up most of the third year generally, and so it really is different depending on which year you're in. The second year is important because especially when you have a brand new president in his first term, and they all do this. They try to spend their first 2 years declaring that, oh my gosh, everything's wrong, everything's even worse than I told you during the campaign. We need to fix all of it, and the only solution is whatever the guy's proposing. Well, investors tend to get bummed out hearing that everything's wrong and everything's bad. And so that's why the market is generally more flat in the first 2 years. In its final 2 years, every president we've seen, he tries to spend the final 2 years declaring victory for having solved all the problems that he'd solved in the first 2 years and running for re-election. And when the positive mood of positive comments is everything that everybody hears in the newspaper all the time, people get more optimistic. And so that's why the third year is generally an up year. So we're still in that unknown second year where our current president is trying to solve lots of problems, and we're worried about what's going to happen with the midterms, and we're worried about what's going to happen with tariffs, and there's worries about this and that and everything. And so we're all just collectively worried. And that's why you get a corrective period for stocks. And it's normal. It happens every time, more or less and in different ways, but it's a characteristic pattern of the market. So people shouldn't be too upset and worried about it and thinking that it's different this time, even though President Trump arguably is a very different sort of president than what we're used to. The stock market's behavior under him is really acting a whole lot like how it usually acts.
Yeah, and I saw most of your charts where once we get into October, things really are expected to pick back up again. And I just want to point out, I know that October gets a bad rap sometimes because of 1929 and 1987. But if you look back just over the last 2 decades using the seasonality chart at stock charts, October's been the best performing month of the year. And so I think, again, that kind of lines up with what you're looking for, maybe a fourth quarter rally starting with that seasonal strength that we've seen for the last 2 decades in October.
Sure thing. Octobers are scary. October has a very well-deserved reputation for scariness, but the scary times are the best times to buy.
Do you have any themes going forward? Like, you're expecting the market to go up at the end of the year. Are you looking for themes, relative strength, something like that, that would help you decide where you want your money to be if the market does in turn, move higher later this year and into the next few years, like you alluded to?
Well, when you're at a bottom, that like the bottom I expect to come up in September, it generally works to buy the most oversold. When you're in the middle of an uptrend, you want to buy the new high list and the relative strength leaders. You don't want to buy the relative strength leaders at the bottom because they may be leading just because they don't go down as much. Mm-hmm. And so it's different depending on which environment you're in. So getting the first start, you want to buy the most oversold. As the uptrend goes on, you want to rotate into whatever is showing its leadership, and stockcharts.com has great tools to do that and show who's winning the race the fastest.
Yeah, that's an excellent point you make, because a lot of times when you get into those downtrends, especially into a bear market or even just a correction or consolidation, many of those defensive groups will lead just because folks are looking for safety during those periods. It doesn't mean that they're going to be leading the next rally to the upside. I think that's a great piece of advice that you just gave there. All right. Well, we got about a minute. Do you have any final comments, on the market here in the near term? I mean, I know that you're looking for the market to pull back. Do you think that it's going to be a steep decline, or are you just looking for weakness and consolidation through that September period?
Well, we haven't had the sort of grand divergence in the advanced decline line that you would get before a 2008 bear market. We had huge divergences in the advanced decline line then. Right now, we're just having a little tiny divergence. It's just saying that there's a little bit of weakness. So I don't think that we have to go crashing down hard. I don't think that we're going to probably exceed 10% to the downside. But 10% is a decline you'd want to avoid between here and late August. And so not the end of the world, but a tradable down move.
Absolutely. Well, Tom, it's always a pleasure having you on here. We always enjoy having you on here. I know our audience does as well. Fascinating charts that you brought in here this time and every time you show up. So I just want to thank you for stopping by again and giving us your latest on the market, what you're looking for.
Well, that's so nice of you to say. It's fun to do it with you guys. Fun to be with people who really like looking at charts and getting information from it.
Yeah, you found the right place. And we're really looking forward to next month, heading out on the cruise, but also seeing you at ChartCon. Can't wait.
All right.
All right. Take care, Tom. Appreciate it.
This video will show you how to add a date line to your charts. So if you have a whole bunch of stuff piled up here and you want a date line farther down, there is a way to put it on there and how to move it. So Down here under indicators, it's one of the options, date time axis, and by just moving it up and down with these triangle arrows, and notice this little blue arrow that moves with it, it'll help you position it exactly where you want it.